I'm absolutely delighted to be joined now by Gaurav Sharma. Thank you so much. Gaurav is the oil and gas markets analyst for Sharecast. Now, you've been looking very closely at non-OPEC supply, and of course everybody's looking at non-OPEC supply. I'm wondering what's going on there. But give me your analysis of it.
So we did a recent examination of the North American market. Now, in that context, we think the key thing here is who can sort of survive lower for longer. Now, we're looking at an era of sort of prolonged. If you're looking at an era of prolonged low oil prices, how can things finance themselves? Now, if you look at key projects in North America, what we are encountering from our surveys of banks is that some of the biggest banks in the States are financing oil and gas projects on an even keel, but on an annualized basis, we think that come the end of the year or 2015, their finances will be about 25% lower than they were last year. And the empirical and the anecdotal evidence that we have is that the big four US banks are probably financing oil and gas projects less and less in ever greater volumes. Is the situation materially different from past downturns? I would say not particularly, but what's the key here is that if this era of oil prices lasts, we were sort of in the low 40s and perhaps might go below $40, then a whole lot of players would be in a lot of trouble in North America.
So the banks are basically getting fed up with some of them. They're just getting fed up spending, loaning money and making sure they've got money. And of course, when this happens, highly capitalized industry, you need a good, strong bank to actually keep you going here. If that money is taken off from the banks, what's the hope of it coming back on? Should the price go back up again?
Well, the marginal players will be in a hell of a lot of trouble. That's what I can say. If we look at the shale industry, we can't take it on an even keel. There are certain disparities there. Now, projects in North Dakota might be in trouble. In Permian, they might be in trouble. But the Eagle Ford, Texas shale prospection is sticking on rather nicely. So you will have a certain disconnect there, that certain projects will get financed, the others will get financed, but at a slight premium to what the industry has been used to. And that is where the difficult bit is. A lot of people here think, well, shale is sticking on nicely. The production is there, but over the course of 2016, we surely expect that production to decline. Maybe not fast and in a fast and furious pace, but it will certainly decline. I expect the Eagle Ford Texas shale prospection to hold up, but you might see Permian in North Dakota, you might see a lot of shutdowns there. Also, private equity will not provide some sort of a panacea. They're there, we keep hearing this, they've got loads and loads of money, but they're after quality assets. And for those quality assets, there's a disparity between the bid and the ask. A lot of sellers in non-OPEC sellers are kind of in denial. Will our asset get the price that it does? And it all points to shutdowns, in my opinion. You will see the odd party go under, and that will take battles out of the market. The critical component here is how do we see the incremental supply from some of the OPEC members balancing that out. I see a decline in North America, but I see a marginal uptick in OPEC.
When we look at the investment in the market, we've seen so much money come off in terms of investment. You're saying now the banks aren't as willing to loan, so that funding is going to be dried up. But the big investment that should have come from the big international companies, indeed from many of the companies, something between 200 billion, 300 billion, whoever you talk to, that's a huge amount of investment that's not going to happen. This is going to have detrimental effects down the road, though, isn't it? What do you think?
Definitely. We're looking at about $60 billion of decline per quarter in terms of final investment decisions being delayed by the IOCs. I'm not saying these projects will never come on stream, never say never in this industry, but $60 billion worth of cuts every quarter. You're looking at probably quite a sizable chunk of barrels being knocked off the market. Now, in terms of putting a value on it, the jury is still out. A lot of people come. Our tally puts at about $260 billion worth of final investment decisions being put on ice, effectively.
And when you look at figures like that and just think of all the investment and all the projects that would have actually meant, what do you see then are the implications sort of near term and probably worse, longer term?
Probably, in the near term, we probably think about 600,000 barrels of being knocked off per day, probably quite possibly by June. Could be more. Because a lot of companies are saying they're not committed to their final investment decisions, but they haven't actually gone to the media and said that this is particularly on ice. We've had some noticeable moves from Shell, for instance, with the Arctic. They've decided they will postpone that. We have had other overtures, but I think there's a lot. I see a lot of projects being put on ice between now and June, and that should provide some sort of support. But at the moment, we have about, by our estimates, about 1.3 million barrels per day of oil extra surplus in the market.
Again, we look at the demand picture. I mean, we have seen some pickup in demand. We've certainly seen the expectations for next year as well. Maybe not the first few months, but the expectations for a pickup in demand are certainly there. Will that be enough, do you think, by the time this comes on board, hopefully in a few months, that it will actually find its own balance and the market will do, what very much it was set out to do in a way?
A lot of people are looking at Indian demand. We happen to be one of those. If you look at the big five, you look at US, South Korea, Japan, India and China, I think India is the big hope among the big five. The US is not turning to international markets for obvious reasons, for its own domestic production. We also think the South Koreans have pumped in economic stimulus in the economy. So their demand is sort of, it's slightly confusing at the moment whether it's going to see an uptick, but it's not in a bad place. As far as the Chinese go, based on the customs data, we had a few bad months this year, but broadly it's sort of held because the market consensus is that they're building the strategic petroleum reserves. Now you take all these big five, I would say look at India first, followed by South Korea, followed by Japan, and then of course the US and China. The picture is a little bit fuzzy.
But when you look at growth in China, and we've seen it, cool down for a while too, but we're still seeing substantial growth in that country, and we're looking at huge numbers as well. How optimistic are you in terms of, China still being able to maintain growth? And again, leading by consumption. This is definitely a consumer play, isn't it?
See, if you look at Chinese growth, half the countries on the planet would kill for that level of growth. It's tepid at the moment, but it's tepid relative to their own spectacular growth over previous quarters and over previous years. So Chinese demand might not fire up, but there is not going to be a sort of a carte blanche retreat from the oil market that suddenly overnight Chinese demand plummets so substantially that it has an overbearing impact on the market. I do not see that happening. Even if China grows, let's say, there's a dramatic decline. Even if China grows at say 5%, it will still consume, or rather import, more oil than the next 9 Asian economies put together.